Today, I'm revealing my top 2 Fidelity index funds you'll want to buy and hold forever. You're also going to learn how to compare index funds the right way. And if you're invested in Vanguard or Schwab, don't worry, the principles in this video apply to all providers. Whether you got a $1 million portfolio or just starting out, I'm confident you'll get value from this video. I've spent hours researching Fidelity Index funds across YouTube, Reddit, books, online forums, and everywhere in between. Stick around till the end because I'll show you why, when it comes to low cost index funds, your rate of return matters way more than the expense ratio. And honestly, once you watch this video all the way through, you might end up rethinking your current funds or even rebalancing your portfolio based on what you learn here. Let's start with the basics real quick. What are index funds? Think of them like a basket of stocks that automatically mirrors the performance of the broader market. It's like set it and forget it kind of meal, except instead of food, it's your financial future. Why do people like index funds? They have low costs, they provide diversification, meaning you're not betting on just one company. Instead, you're investing in a whole group of companies. Think of it like a family sized pizza. More slices, less chance of a terrible topping ruining your day. Now, let me show you how I pulled the data for this video so you can do the same on your own. You don't even need to log into Fidelity. Just Google the fund name like FXAIX and click the link to the Fidelity website. That will take you straight to the funds page where you can check key info like performance to see how the fund has done over the past 1, 3, 5, and 10 years. If you click more, it will even show you the lifetime performance since the fund was started. Going back to the summary page, it shows you fund inception date, basically when the fund was launched. Expense ratio, this is the annual fee charged by the fund to manage your money. The lower, the better. Minimum investment. For all the funds we are covering today, there is no minimum. You can invest with just $1. Turnover rate. This tells you how often the fund buys and sells its holdings. Lower turnover usually means lower costs and fewer taxes. Top 10 holdings and what percentage of the fund they make up. Super easy, even if you're just starting out. Now, if you want to compare funds, Fidelity has a great tool for that too. Just hit the compare button. If you know the fund you want to compare, enter the ticker like FNILX and hit add. You'll get a side by side view of returns, expense ratios, and other key stats. If you want to browse all Fidelity index funds, just go to News and Research, Mutual Funds, Index Funds, and then choose Fidelity Funds and hit View. You can scroll, sort, and play around with all the options there. Alright, now let's look at my analysis. I narrowed it down to 6 popular Fidelity index funds. First, I'll walk you through 4 of them and then I will reveal my top 2 picks for long term growth. Let's dive into the most popular Fidelity index funds and break down their key metrics. First up is FXAIX, which tracks the S&P 500. This fund gives you exposure to the top 500 US companies. It's the go-to pick for a lot of investors, kind of like the vanilla ice cream of index funds. Classic, reliable, and surprisingly powerful. Total holdings is 507, which means it has 507 different stocks within the fund, covering large cap US companies. Top 10 holdings is 35%. This means the top 10 companies in the fund make up 35% of its total value. These typically include the largest companies in the US like Apple, Microsoft, and Amazon. 5-year return is 18.58%. This is the annualized return for this fund over the last 5 years. 10-year return of 12.49% is a strong performance, especially for a fund with such low fees. Expense ratio. Again, this is the annual fee the fund charges to manage your money. It's automatically deducted from the fund's returns. This fund has a expense ratio of 0.015%, which is very low. For every $1,000 you invest, you'll pay $1.50 annually in fees. Anything below 0.5% for index funds should be fine. Anything above 1% is considered high and can eat into your returns over time, especially in the long run. The funds we are looking at today have very low expense ratios of less than 0.3%, which means most of your money is staying in the fund and working for you. Turnover rate of 3% is very low, which is very good. A good rule of estimate is that for every 10% portfolio turnover, expect a zero point 0.1 drag on your performance. So, if a portfolio has 100% turnover, it could reduce performance by 1% on top of the fees you're already paying. Now, let's look at FNILX, the Zero Large Cap Index Fund. What is it? This is a large cap fund that focuses on the biggest US companies. The metrics are pretty much same as the previous one, except for expense ratio. Since this is a zero fund, expense ratio is 0%, which means there are no fees for managing this fund. It's like having the VIP pass to the biggest companies in the US without paying the entry fee. Since FNILX is a newer fund, we don't have a 10-year return yet. Next, let's look at FSKAX, which tracks the total US market. Think of this one as the all-you-can-eat buffet of index funds. It doesn't just stop at the S&P 500, it grabs everything from the big players to the small fries. It's a broad market index fund that includes small, mid, and large cap stocks. And so obviously, it has close to 4,000 total holdings, giving it even more diversification than previous ones. 10-year return of 11.74% is a bit lower than FXAIX. Rest of the metrics are same or similar to FXAIX. Finally, FZROX is another zero fund. It's a broad fund that covers small, mid, and large cap stocks, similar to the previous one. FZROX holds more than 2,500 stocks, has a good 5-year return of 18.28%. It doesn't have a 10-year return yet since it's a newer fund. Expense ratio is 0% because it's another zero cost fund. Turnover rate of 2%. This is even lower than the other funds, meaning fewer trades are made and lower costs overall. This one's also a solid zero cost option for broad market exposure. Now, let's get into my top 2 picks, which I believe offer the best potential for long term growth. FSPGX is my first pick for long term growth. Here's why. This fund focuses on large US companies that are expected to grow quickly. These are companies leading the market and growing faster than others. The fund holds 399 stocks, giving you a mix of many strong companies while still focusing on the big ones that are expected to do well. The top 10 companies make up 59% of the fund. This means the fund's strong returns come mostly from these top companies. By investing in these big growing companies, the fund has been able to perform well. Over the past 5 years, this fund has grown by 20.05%, showing it's been a solid performer. The growth is driven by the strong companies in the top 10. At 0.035%, expense ratio is still very low, though slightly higher than other funds, but it's worth it given the strong growth potential. Turnover rate is slightly higher compared to other funds. However, the strong performance of this fund more than makes up for it. The slightly higher turnover helps the fund stay focused on the best performing growth companies. In short, FSPGX gives you strong growth because most of the money is invested in the top US companies. Despite the slightly higher turnover rate and expense ratio, the strong 5-year return and concentration in leading companies make it my top pick for long term growth. FNCMX is my second pick for long term growth. This fund tracks the NASDAQ Composite Index, which is heavily focused on technology and growth companies. If you're looking for exposure to some of the biggest tech stocks like Apple, Amazon, and Tesla, this fund is a great choice. FNCMX holds over 2,800 stocks, offering a broad and diverse exposure to the NASDAQ market. This gives you a mix of tech companies as well as other high growth sectors. The top 10 companies make up 50% of the fund, which means it's focused on the biggest, most influential tech companies driving growth. This concentration in top tech stocks helps the fund perform well, especially during periods of strong tech market growth. Over the past 10 years, FNCMX has delivered an impressive return of 14.46%. This shows you how well it has capitalized on the long term growth in the tech sector, particularly with companies in the NASDAQ. Expense ratio for FNCMX is 0.3%, which is still very low compared to actively managed funds. While it's slightly higher than some other funds, the performance of FNCMX makes it worth the fee. Turnover rate is very low at just 2%, which means the fund isn't making constant changes to its holdings. This keeps the transaction costs low and makes it more tax efficient for long term investors. Overall, FNCMX has performed exceptionally well thanks to its focus on tech and growth companies. With solid 10-year returns, a low turnover rate, and an exposure to leading tech stocks, it's a great choice if you're looking for high growth potential in the long term. Now, let's validate these choices using a hypothetical 30-year scenario. Here's how the rate of return and fees affect your investment over time. Spoiler: the higher your return, the bigger the pizza slice you will get after 30 years. For this example, the calculation only involves the expense ratio. It doesn't include the turnover rate. But that shouldn't change the story much. The turnover rate is relatively low in these funds, so the effect on your overall return is minimal. With an initial investment of $1,000 and $12,000 in annual contributions, here's what we would expect for each of the top funds. For FSPGX, with an assumed return of 15.46% over 30 years, you would see your investment grow to over 6.6 million after fees. For FNCMX with an assumed return of 14.46%, your investment would grow to about 5.1 million after fees. As you can see, the rate of return makes a huge difference over the long term. Even a 1% difference in return might not sound like much now, but over 30 years, it can be the difference between retiring comfortably or retiring rich. That's the insane power of compounding working in your favor. And that's exactly why you should pay more attention to long term returns than just chasing the lowest fees. A fund with slightly higher fees but much better performance can still leave you with way more money in the end. Because at the end of the day, that's the whole point of investing, to grow your money and build real wealth over time. If you're new to investing and now you know what to invest in, you might be thinking, okay, what do I do next? The next step is to open a brokerage account if you don't have one. For US investors, the top options are Fidelity, Schwab, and Vanguard. I personally use Fidelity because of their great customer service. I can just call and talk to someone about any question. Their user interface is clean and easy to use. Also, all my accounts like Roth 401k, Roth IRA, HSA, individual taxable brokerage account, and a joint account with my spouse are all in one place in Fidelity. I initially chose Fidelity because they let you invest using fractional shares, so you could start small and still buy into top funds. Once your account is open, you link your bank, transfer money, and you're ready to invest in the funds we just discussed. If you're into individual stocks, check out the playlist in the description. I've got a video on my top 11 stocks to buy in 2025 and another one where I reveal my HSA stock portfolio, both packed with insights. Feel free to check them out. And if you have any questions at all, whether it's about index funds, accounts, or how to get started, drop them in the comments. I'm happy to help. You got this.